you have a house and you have debt, don't be afraid of refinancing when rates are higher because it could wind up saving you hundreds of dollars a month. Wait, so how does that work? If I refinance, I'll get a higher interest rate and I'll lose my low interest rate. So how in the world could that save me money?
Let me explain. No, there is too much. Let me sum up.
So here's a scenario I recently came across. I did change the numbers to help keep our client more anonymous, but they're still adjusted to keep the same proportions. They're marginally rounded up. So this can also help show how a client who might have a larger debt burden could still benefit from something like this. So this client, they've lived in their home in Utah for about the last 8 or 9 years, and as such, they've built up a lot of equity. They have a low interest rate on their mortgage. They pay about $1,600 each month, but they also have these other expenses and debts too that they're paying monthly on. They have a HELOC for $25,000 for a kitchen renovation that they took out when rates were low, but because that's an adjustable rate line of credit, they are now paying $331 per month at almost 10% interest trying to pay it off. So altogether, they're paying nearly $2,600 every month. But here's the thing, they have equity in their home that's just sitting there. And while it's sitting, it's doing nothing. Having a low interest rate and lots of equity doing nothing for you is like a dusty trophy sitting on a shelf. It's a talking or bragging point, but is it really helping you? How can you leverage your equity to increase your cash flow each month? With refinance, we can take that home's equity that's accumulated and put it to use to pay off this client's debts. So here's what it looks like in this scenario. They could take a rate in the mid-sevens because that's about the average rate we're seeing right now, but disclaimer, because I have to use disclaimers, some interest rates may be higher or lower depending on each borrower's qualifications, and in this case, it includes a lender credit to pay for the closing costs of the transaction, so that's why they're getting their rate. And what they get in return is that they get out of debt. They completely pay off the credit cards that have 18% and 24% interest rates. They pay off the HELOC that has 10% interest. They pay off their auto loan with 5% interest. So all they have left is their mortgage payment, and they're still able to save $300 every month. So if we averaged all their debt's individual interest rates together to find the blended rate, you'll see that they were paying an average of 11.3% interest. So yeah, even though they're giving up their mortgage rate that was in the threes, a rate in the sevens is now giving them more cash flow every month, and cash flow is what counts, what actually helps families. More cash flow means they're finally out of debt. They can start saving money, put their kids into a dance class or sports program that they've been wanting to do for a while now. Save for that family vacation, put more money aside for retirement or an HSA, whatever they want to do. And their credit score will also increase because we just dropped their overall credit utilization down dramatically. And if interest rates go down further later on, we can refinance them to help them save even more money each month too. So this is just one example of how you can pay off debts while increasing your monthly savings. So if you have debt and own a home, let's put your equity to use so it can help shoulder the burden. Contact me to find out more.